You know, the markets on March 11th gave us a real head-scratcher. It felt like we were watching two completely different stories unfold at the same time. On one hand, you had the very real threat of global conflict casting a huge shadow. And on the other, you had the AI revolution just powering forward, almost unstoppable. So let's break down exactly what happened.
And here's that puzzle, right here in black and white. The Dow Jones, the backbone of the industrial economy, it took a real hit. But then you look at the tech-heavy Nasdaq 100, and it actually finished up. Just barely, but still. So what on earth is causing this spit? Well, to get it, you really have to understand the two massive opposing forces at play right now.
Okay, first, let's unpack the big one. The force that's been pulling the traditional market down today, and that's the growing fear over geopolitical conflict.
What really set things off? It all comes down to this number. A nearly 5% jump in crude oil prices in a single day. Now, this isn't just some number on a screen. This is a direct shockwave to the entire global economy. It immediately sparks fears of inflation coming back and puts the brakes on growth.
And this quote from Professor Günter Dweck just hits the nail on the head. His whole point is that when a major threat like a war pops up, we don't think like accountants. We react with our gut, our survival instincts. And our modern economy, which is built for maximum efficiency, well, it's just not built for these kinds of sudden shocks. It's actually quite brittle.
And this right here shows you exactly what Dweck is talking about. You've got a company like Campbell's, right? Huge physical supply chains. They are immediately vulnerable to a spike in energy costs. And you see how the market punishes that fragility. The stock got hammered. But then you look at the tech story. It's driven by innovation, by code, not cargo. And it proves to be way more resilient.
Now, what's really fascinating is how this fear starts to feed on itself. It actually begins to shape reality. And that's the whole idea behind George Soros's theory of reflexivity. Our beliefs, our biases about the market, they create these feedback loops that can turn into self-fulfilling prophecies.
And here's what that negative loop looks like in real time. It kicks off with oil prices jumping. That sparks fears about inflation. That in turn pushes bond yields higher, which makes stocks look less attractive. So stock valuations start to fall. Investors see this, they get nervous, they start selling, and that selling just pushes valuations down even more. It's a classic downward spiral, and it's all fueled by fear.
And you can see this effect was even stronger over in Europe. Just look at the German DAX. It fell more than twice as much as the Dow. So why the huge difference? Well, it's pretty simple, really. Europe's economy is just far more exposed to sudden shocks in energy prices, which makes that whole negative feedback loop even more powerful over there.
But that's only half the picture. Now, let's flip the script and look at the other side of the story. This incredible counter-narrative from the AI revolution that's basically defying economic gravity. I mean, if there was one star of the show today, it had to be Oracle. While so many other companies were stumbling, Oracle just soared. Up over 8%. And the reason is simple. Their earnings report confirmed this massive, booming demand for cloud infrastructure. All the essential plumbing that's needed to power this whole AI explosion.
So why does a story like Oracle's matter so much right now? Well, to really get it, we can look at Professor Aswath Damodaran's theory of the corporate life cycle. He argues that just because a company is mature doesn't mean it's destined to just fade away. With the right kind of innovation, it can achieve a total rebirth.
And this just lays it out perfectly. It's like looking at two completely different worlds, isn't it? Oracle is the rebirth, an old guard, established company that has suddenly found this explosive new growth story in AI. And then there's Campbell's, also a mature company, but without that new story to tell. So it's left completely exposed, just getting squeezed by all these rising costs.
So here's the bottom line for today, the most crucial takeaway. Right now, investors are putting a higher value on a compelling story about the future than they are on a stable past. That promise of AI-driven growth is acting like this powerful shield against all the fear that's gripping the rest of the market.
Okay, so we've got these two huge opposing forces, fear on one side and innovation on the other. So where does the market possibly go from here? Well, for that, we have to turn to the data.
So, the analysis we're about to look at isn't based on feelings or guesswork. It uses advanced quantitative models to cut through all the noise from these competing stories and just project a likely path forward for the rest of the month.
And here's what those models are telling us. They're predicting this split we saw today is going to continue. They're forecasting more upside for the tech-heavy Nasdaq and also for semiconductor-driven markets like Korea's KSPI. But for the Dow, and especially for the German DAX, the forecast is pointing towards a continued slide.
This chart just drives that point home, doesn't it? It shows the forecast in really stark terms. You can see that clear divide between the markets that are being powered by the AI story, like the Nasdaq and the Kospi, and those that are still feeling the heavy weight of the energy crisis, like the DAX.
All right, let's get to our final section, and maybe the most important part: how this analysis actually translates into clear, data-driven strategies you can think about for navigating this really complex market.
Okay, strategy number 1 is all about playing this divergence we've been talking about directly. It means going long on the clear winners, the AI leaders like Oracle and NVIDIA, and even energy producers like Chevron who benefit from high oil prices. And at the same time, it means shorting the companies that are most vulnerable to these high costs, like Campbell's or the airlines.
Now, the second approach is for those of you who like to go against the grain. It's a contrarian play. It means you wait for those moments of absolute maximum panic. You know, when the VIX, the market's fear index, is spiking and the headlines are all doom and gloom. And then you start buying into the markets that have been beaten down the most. The logic here? Often, by the time fear is at its peak, the worst news is already priced in, which can create a pretty powerful opportunity.
And finally, strategy number 3 is all about playing defense. This allocation is based on a Monte Carlo simulation model, and it suggests holding a pretty significant 35% of your portfolio in safer assets like cash, gold, and defense stocks. It's really all about building a buffer to help you weather the storm, because the volatility is probably far from over.
And that really leaves us with the central question, doesn't it? Today's market is a battlefield caught between two incredibly powerful forces: our primal fear of conflict and our unstoppable drive for innovation. The data and the theories we've walked through can give you a map, but ultimately, how you navigate this market comes down to which of those two forces you believe will win out in the end. Thanks for tuning in.